Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial, investment, retirement future. Facing the difficult challenges and questions in the financial world, he is Chris McIntire, president and founder of McIntire Retirement Services. And Chris, glad you're here. Glad you face these difficult challenges, because it seems like the folks up in Washington, D.C. don't want to face them. Playing chicken with the world's largest economy as we head toward this debt ceiling crisis and deadline, and the Treasury running out of their general fund account.
Yeah, and you look at a deficit of $32 trillion, and if you needed any more reasons to vote out established politicians, right there it is for you folks. So Peter threw that at me right away. I had to hit it, right?
Yeah, absolutely. I mean, fiscal responsibility, Chris, is something that you help people understand and teach and practice each and every day, putting plans together for individuals so that they can remain financially stable and confident. And yet it seems like we could be undermined by the folks that we elect to keep our financial stability going and in place, as well as of course, our overall global and economic stability.
You're right, Peter. We talk about the dollar being the reserve currency around the globe. And a lot of my clients, that's been on their mind this year, has been, well, what happens if the dollar's not the reserve currency and the Chinese currency, the yuan, becomes, much more powerful to the dollar? If that weakens the dollar, that's bad for inflation, obviously, because it takes more dollars to buy the goods. And, but back on the debt ceiling topic, there is, Peter, when I sit across the table from clients, I have a fiduciary responsibility to act in their best interest. And I think most people out here today, regardless of what political party you're more affiliated with, continuing to deficit spend by the trillions, isn't in anybody's best interest. So hopefully, we get some sort of debt ceiling relief here and they stop digging the hole deeper, because one of the downsides is, look, we got record tax revenue coming in. We've got a good employment picture. If they can't pay down the debt when things are wonderful, what makes you think they can do them when things are terrible?
Yeah, absolutely. So, Chris, I know that each individual needs to have a plan for their own financial confidence, well-being, sustainability, especially as we are walking away from the paycheck into retirement or living off those assets in retirement. And so we're going to be talking about that today, but parlaying from the conversation of more systemic concerns with the debt ceiling debate. This is something that each and every day we need to focus on in our own world and sphere of influence, to make sure that we've got that plan, that we understand what each and every dollar is doing and how it is going to work to help us achieve that financial confidence into and throughout retirement. And again, ladies and gentlemen, Chris McIntire is your resource across Northwestern Ohio, multiple offices conveniently located nearby you. If you would like to get together with Chris, if you'd like to start with a phone call or a virtual meeting, just pick up the phone and give a call to the office of McIntire Retirement Services. He does offer the service of putting together that game plan for retirement. No cost, no obligation. It is the extension of the information on this radio program, and the true value of having a resource like Chris is the ability to speak with him and talk about your situation, your goals, defining those, and structuring the plan to work to help you achieve them. 800-868-1194, the number to call, 800-868-1194, 800-868-1194. So, Chris, if we are seeing this debate about the debt ceiling, if we are hearing so much about how into the third or fourth quarter of this year there could be a coming recession, it seems a little bit like a self-fulfilling prophecy. What is a more conservative or risk-adverse minded investor to do in light of these circumstances?
Yeah, so if we deal with somebody that's really planning for retirement, and we're talking about a larger dollar amount, we're structuring income, so we're looking for pieces that we can get some contractual guarantees of safety of principal, ongoing income streams that if something happens, it pays to your spouse. If there's money left over, it pays off to your beneficiary. So, this is where the annuity piece of things can certainly be, something worth considering for many investors out there, who have some sort of, are conscious about volatility and want to have some protected assets.
And Chris, I think that a lot of people moving through the last 18 months, 2022, a pretty rough year in the market, are looking at conditions and saying, hey, I don't want to, I cannot stomach, and maybe my financial outlook cannot take further losses from this point. 2007, 2008, still a bit of a distant memory, but a memory nonetheless. And there are options, right? There are steps we can take within the construct of that plan and looking at the balance of assets that can help us to preserve and protect principal, protect income, and in many cases also help us to control and minimize taxes.
Certainly are. And if we look at the annuity landscape, there's breaks down to two different types, okay, that we use as investments. They're tax deferred. So if you don't need the money right now, okay, you're deferring the taxes. If it's part of your IRA platform, it's already tax deferred. So no need for, the double tax deferral doesn't do you any good there. But there is the fixed annuity that we utilize that is safe. Okay? And you might be able to find a 3-4 year fixed annuity, kind of like a CD at, call it 4 or 5, depending on the company, depending on the month. But in that, we've had 5.5% interest rates for 2, 3, and 4 years here for the 2023. And who wouldn't want that, especially if you can tax defer it? Okay. On the other side of it is the fixed index annuity, where your performance is linked to a stock market index. So you might have higher upside potential than just going the traditional route. Plus, you may have some bonuses that get added to the annuity's value if you're going to structure an income out of it and take it as a lifetime income payment. So sometimes you can get good, solid, steady growth, principal protection, maybe no fees, or if you have an income element on it, it might have you might have a little bit of a fee there that you've added an income rider to it that gives you a cost of living adjustment, many different facets. But again, principal protection, when you make money in the index annuity, you can't lose it going forward when the market goes down. We call that an annual lock-in, is a very common piece. And then when the market falls, like it did in 2022, for example, and the S&P 500 was down, let's just say 20%, your index annuity didn't lose any money, but for the next year going forward, you reset on your anniversary date, the date the annuity started. We call that an anniversary date. And then you go forward from that standpoint. So you can make money on the recovery side, where if you're invested in like an index mutual fund, you have to recover the lost dollars. The index annuity space, you don't have to recover the lost dollars. You can make new money on the recovery side, if that makes sense.
Well, Chris, with record purchases and deposits into annuities in 2021, 2022, and so far into 2023, these qualities of protection must be something that investors are finding attractive. That, coupled with the fact that this generation, by and large, is missing the pension, and then the question surrounding the stability and longevity of Social Security, it makes formulating that income plan and that predictable income generation in retirement that much more important for us in the current environment as retirees.
Yeah, I couldn't have said it any better there, especially that income element there. And by and large, my happiest, or, I'll say my clients with the most peace of mind have very solid income plans for their retirement. Okay. They're not always worried each day at what the stock market's doing and am I going to outlive my money, and obviously we run into lots of different investors in different shapes and sizes. And, many people listening to this radio show today, myself included, we have to structure our own income. We're going to have Social Security, and, I'm 58 years old, and yeah, I would be, I am concerned about what is the funding of Social Security going to be down the road. What will the result of the shortfalls that it has, and so, I'm going to rely on building my own income streams, and hopefully Social Security remains a nice, sound, solid foundation for retirement planning. But, you can read your Social Security statement and that's not what it says.
Well, I know that we need to have that baseline of income for financial confidence into and through retirement, which has traditionally been through guaranteed streams of income, Social Security and pensions with the previous generation. Today, the questions of the market volatility and the large reliance on investment assets, Chris, the 401k, the IRAs, and market-based components, leaves that question of income in retirement up to a bit of chance, and certainly whatever the results of the market are. And I know that you work through that with your clients and talk about the fact that, yes, the market is a fantastic long-term tool, but in any kind of given period or 1 year, we don't know what the results of the market might be. And again, facing these headwinds here currently.
Sure. When we're investing in stocks and bonds, because bonds fell in 2022, to be fair, Peter, we're looking at what we call sequence risk. Okay. So you can position an annuity to help you mitigate that sequence risk. Okay. And that's where, it would become a very viable tool. And again, we use the fixed or the fixed index annuity side in our practice. We do not use variable annuities. I just find them very costly. And then they have the inherent risk of investing directly in the stock market. We can do that typically very cheaper with a good low cost portfolio. And then we come over here on the safe side, structure a good quality annuity to complement Social Security and maybe pensions. And then we kind of satisfy those guaranteed income needs that they need for those lifetime, those, daily living expenses, if you will. Then on the investment side, we can say, hey, we're going to invest a portion in good quality dividend paying stocks that are paying dividends, okay? Or, find some nice quality bonds and whatnot that are paying interest to help complement the guaranteed side of things that you have between Social Security, pension, and an annuity. And now I'll look at it this way. I'm on the podcast. I've got 3 fingers in the air. If you were going to sit on a retirement stool, would you rather have 3 legs or 2? Just Social Security and your pension, or Social Security, a pension, and your annuity piece. So if you have 3, you're doing wonderful. And then if your spouse has, a couple of sources of income, you're even all the better. But, the more legs you have to your income story, the more stable it's going to be, obviously.
Chris, you, again, talking about market conditions, the uncertainty that we are facing in the market, the debt ceiling debate, the discussions of oncoming recessions, the potential at least thereof, are talking with a lot of people looking out into the future and wondering what the stability of their retirement may look like. Bottom line, that's where the plan comes together. We have tools, we have investment accounts, we have retirement accounts, but those do not constitute a plan. You have to bring those together and look at investments, income, taxes, healthcare, legacy, and many subcategories and points in each. That is what the game plan for retirement really helps people to piece together, see the whole picture of the retirement, and really have that plan in writing. Once again, ladies and gentlemen, it is a service that is offered there at McIntire Retirement Services. No cost, no obligation. If you'd like to get your game plan for retirement put together, pick up the phone, give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. You earlier mentioned, though, that the annuity would not help improve the tax deferral of an IRA. So can we talk about that point for just a moment? Can we put an annuity and guaranteed income in place in lieu of or inside of the 401k or tax-deferred retirement nest egg, the IRA?
Yeah, you certainly can. And you can even do it with a Roth IRA where it's income tax-free. So the tax deferral would probably be more of a benefit for somebody that had money in a savings account and they wanted to put it into an investment vehicle, defer the taxes. That's where that would come into play. Inside your IRAs, your 401ks, when you do your rollovers, an annuity can certainly be part of an IRA platform. It works on both sides is probably a good explanation, non-IRA or IRA assets. And, I guess if you're going to give it a rule of thumb and paint with a broad brush, like we do a lot of times on the show here, Peter, is, IRAs are usually a good spot for annuity because most people aren't going to go in there and start pulling out $100,000 a year. They're structuring that to take that out as income in bits and pieces to, mitigate or manage their tax situation.
And bottom line, Chris, even if we don't necessarily need to make withdrawals from our IRA, at some point in time, the government requires us to do so anyway. So formulating that as part of the income plan probably makes a lot of sense regardless of our situation, right?
Yeah, absolutely. And, they're a very useful tool when used in the right place. You don't put all your eggs in one basket. We're certainly not advocating that, folks. We're talking about, building a retirement plan and carving pieces off for investments, pieces off for also for income or safety, if you will. So again, you typically aren't going to put all your eggs in one basket by any stretch. You're not going to use Amazon stock as your only tool, even though Amazon stock could quadruple in value in a very short amount of time. It can also go down like it did last year. So you build a very diversified, well-balanced portfolio using Wall Street, banks, insurance companies, and that gives you some good diversification in a lot of cases is obviously in your very best interest to do so.
Yeah, and what goes up very quickly, we have often seen lose value, significant value very quickly as well. If it follows the returns of the market or beats the market in one direction, Chris, it can follow the returns or beat the returns in the other direction just as easily. And all too many of us found that out last year in 2022. And in fact, Chris, because the 401k by and large is kind of on autopilot and a little bit out of sight, out of mind, a lot of people have not gone through the practice of routine rebalancing. And as a result of a good run in the market for the previous decade, we're probably overexposed to an appropriate level of risk and experienced more losses than they otherwise would have or needed to.
Yeah, they certainly could be, Peter. And, and even people who manage their own assets in their own IRAs, we can get greedy when the stocks are going up. We just want to keep piling more money into stocks instead of rebalancing, saying, okay, hey, I've got way too much money in stocks. I need to reallocate into my, let's say your bond portfolio, for example, since we're talking about, 401ks, you typically are going to have your stock bond ratio inside those types of accounts.
Chris, just one of, by the way, the numerous advantages of working with a financial advisor professional like yourself is that you help your clients by executing that routine rebalancing on their behalf to make sure that their plan and investment allocation stays in alignment, correct?
Yeah, absolutely. And because rebalancing is very important, not only, not so much when the market goes up, but when the market goes down. That's where rebalancing can help you mitigate some of that downside exposure.
Well, again, we are talking with Chris McIntire. And if you've got questions or concerns about your financial investment, retirement future, your financial plan for retirement, pick up the phone, get the plan together, get that plan in writing, addressing income, investments, taxes, healthcare, legacy, addressing the risks that you are taking, the fees that you are paying, the taxes that you may be liable for, controlling those factors. That is what the game plan for retirement is all about. And Chris McIntire does offer that to listeners to this program, no cost, no obligation. All you need to do is pick up the phone and give a call to get the conversation started. 800-868-1194. That's 800-868-1194. 800-868-1194. Again, Chris, with record deposits and purchases across 2021, 2022, 2023, even though they have been much debated over time and throughout the years, annuities have qualities that investors are finding attractive right now. And you mentioned a bond alternative. Why do annuities represent a alternative to what has traditionally been considered the more conservative side of the investment portfolio, the bond or the fixed income side?
Well, let's use 2022 as an example then, Peter. And, when interest rates go up, bond prices go down. So, 2022 was one of the worst performing years for bonds because they went down in value because new bond issues, were at higher rates. So older bonds that are in your portfolio were down in value and have yet to recover fully, obviously, here into 2023 because interest rates are still going up. Okay. And again, with bonds, we're not in it to make 18% like we would with an Amazon stock, for example. There, we're in it for growth. Bonds, we're in it for that, kind of that sure, steady, boring part of our portfolio. But last year, it wasn't very boring. It was actually very exciting in the bond market as, you watch those prices decline.
Exciting in a bad way.
Yeah, and especially even the safer bonds, government bonds suffered the worst because they paid the least amount of interest. So higher interest rate increases have a larger impact on them. Now, in all fairness to those that are listening today, if you hold a bond until it matures, you get your money back. Okay. But if you need to get out of it or you own it in mutual funds where there's a lot of redemptions and whatnot that goes on, that's where you get a lot of your losses. The fixed annuity or the fixed index annuity, you can't lose anything unless you pulled your money out early, and that's a surrender charge that's stated in the contract. But as long as you live within the contract, you don't lose any principal, throughout the life of that contract. And it could be 2 years, 3 years, 5 years, 7, 10. In the state of Ohio, no annuity can be for more than 10 years from a surrender charge schedule. So, we've got a very good Department of Insurance that regulates the annuity landscape, the life insurance landscape, and the health insurance landscape, to be fair, here in the state of Ohio.
I'm glad you bring up this factor of the surrender charge schedule, Chris. I do want to talk about the stipulations, right? We've talked about some of the benefits and the attractive qualities of annuities, but there are things you need to be aware of. However, we started the conversation talking about financial concerns, systemic concerns, debt ceiling, the potential for recession. One thing that we had not mentioned yet is the liquidity crisis that some of the regional banks have seen this year. The collapse of Silicon Valley Bank and First Republic and Signature Bank and then PacWest. Can you talk to us about how the banking industry and the insurance industry handle the underlying liquidity better, and why the surrender charge schedules on annuities may just be something that is for the protection of investors, as well as something we certainly do need to be aware of?
Yeah, no question about it. So let's just say you got a 5-year annuity, whether it's fixed or index annuity. Okay, here in the state of Ohio, it might have a surrender charge schedule. If you pulled all of the money out, okay, and again, rule of thumb, most annuities allow you to draw 10% out every single year as a rule of thumb. But, let's say you took everything out in year number 3, okay, and you might have to pay a 7% penalty to get out of it. Okay? If you waited until year number 6, you wouldn't have any penalty whatsoever. Okay? And so when Peter's talking about the banks that have failed here recently, well, they reinvest all of the excess profits and earnings and deposits a lot of times that they get into government bonds. Okay? And in Silicon Valley Bank's case, it was just in the Wall Street Journal. That's why I'm talking about it here over the second weekend there in May, is they had to liquidate those bond holdings, U.S. Treasury bonds, at significant losses because interest rates had gone up and they were selling them at whatever the market value was. So not only did they have a run on the bank to get people's money, they had to sell the safest investment on the planet, a U.S. government bond, at a significant loss because they had not reached their maturity.
So again, kind of something we need to be aware of, something that as we enter into any longer term investment, we need to understand the duration of time that we are making that commitment for, but something that is there specifically to safeguard and protect not only us, but all the investors within an annuity or an insurance company.
That is exactly right. We want good quality, A-rated type insurance companies by and large. And, insurance companies get investigated by the State Department of Insurance. They get investigated by the ratings companies that determine their ratings. And then, and that gives a lot of relief. And again, 2008, we heard tons of banks that failed. 2023, let's call it, because most of the stuff happened this year. You're hearing some other banks that have failed. You're not hearing that on the insurance company side of things, because their job is not to act as a liquidity element like a bank would have, and they have built-in protections to prevent runs on the insurance companies. That's what the surrender charge schedule does.
Chris, 2022 also saw a significant increase, a spike in interest rates. And in fact, one of the quickest and largest increases in the Fed's core interest rate in the last 40 years at least. Now, the talk of the coming recession is something that is of concern, but a lot of times the weapon against recession and what the government policy is to lower interest rates to help stimulate an economy when we see it slow down. That's what they've done in previous downturns in 2007, 2008, during the midst of COVID. Interest rates were dropped during those times. Does that make locking in a currently available interest rate may be something to consider attractive for a longer duration of time?
Yeah, no, without question it does, because, the talk is interest rates into 2024 will most likely get cut as they bring inflation down and try to keep us from going into a severe type of recession where all of a sudden the economy slows and people just stop spending completely. They need interest rates to come down eventually, Peter, in my opinion, to allow the housing market to open up once again. Because, my wife and I, we built a house in 2018 and we're paying 3% interest on our mortgage. Why would I want to move to a different house and maybe pay 6.5% or 7% mortgage, when I'm not paying that now? I'm applying more money to my principal. And, so where that hurts people is, if you're a first-time home buyer looking for a house to buy, somebody's typically got to move out of that house so that you can move into it. So they're locked into their apartments. Okay. Well, guess what? All of a sudden that drives up the demand for apartments. And what happens to rents? They also go up. So unthawing the housing market by lowering interest rates will certainly be a factor that we think into 2024 is going to be a major economic player, throughout the course of the year. And we also will have an election again, next year too.
Well, talking again today with Chris McIntire, president and founder of McIntire Retirement Services, Northwestern Ohio's resource for comprehensive planning for a more stable, secure, and confident financial and retirement future is the team from McIntire Retirement Services. If you'd like to get your game plan for retirement put together, pick up the phone, give them a call, 800-868-1194. That's 800-868-1194, 800-868-1194. And Chris, a lot of today's conversation circled around kind of geopolitical and global financial concerns, larger picture type of challenges that we are facing, but bringing it down to an individual level, there are choices and options. We talked about some of the more conservative options today with annuities that can offer principal protection, income protection, guaranteed income for life, but certainly not the only option that you have available. You have access to the spectrum of the financial world and sit with each individual client discussing their unique goals, come up with that fiduciary approach to what is the best solution for them.
Absolutely. From CDs to stocks, we offer it all, based on the individual, so we can truly customize, a portfolio that meets their goals and risk tolerances and income needs.
If you'd like to get your plan put together, once again, it is an offer made as part of this program, taking it a step beyond the education to application to your situation. That's where the true power lies. So get your game plan for retirement put together, the written plan for your retirement. Similar plans can easily go upwards of $1,000 to several thousands of dollars, but Chris McIntire makes it available to listeners to this program. No cost, no obligation. Just call now, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, we always appreciate your perspective and time.
Hey, my pleasure, everybody. Have a great weekend out there. Thanks, Peter. Take care.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.